Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. Let's take a look at how markets shaped up last night on Wall Street. And we've got some green on the screen, at least for the S&P 500, which is up for a fourth time this week following news that the U.S. and China administrations have agreed to slash tariff rates. So that is seeing the broad market index at 0.4% to close at 5,916. Also seeing gains is the Dow Jones Industrial Average, up 271 points to 42,322. All right, on the other end of the spectrum, the Nasdaq Composite bucking the trend, underwater by 0.2%, so giving back gains from the previous session at 19,112. Among the top movers, we've got Foot Locker surging almost 86% after news broke of Dick's Sporting Goods acquisition plans. Well, lots to unpack here as we take a look at more earnings and what is going to be the consumer's state of mind in the coming quarters. Helping us out is Sonu Varghese. He is the Vice President and Global Macro Strategist for Carson Group. Sonu, how are you doing today? Great to have you back on again.
Well, I'm good. Thank you for having me. Good morning there.
Always great to have you on the show, Sonu. So we've got a couple of things to walk through with you. Let's start first with your main takeaways with how markets have been reacting so far this week. And I think off the back of the deal-making spree that's been going on, it seems like it's going through a nice bounce.
Yeah, exactly. We've had now the fourth day in a row since Monday that the S&P 500 has closed in the green. Today looks a little shaky, but things picked up by the end of the day. And now markets are up since last week. The S&P 500 is now up over 4%. And I think the big jump came after news broke that the U.S. is pausing the tariffs on China, pausing the extreme tariffs, taking it down from 145% down to 30% effectively.
Is it broad-based, Sonu, or are there some pockets of the market still struggling?
This week, the rally has been fairly broad, but there are cross-asset return differentials. For example, if you just look at the S&P 500, it is now positive year-to-date, right? And at the same time, it's just off maybe about 4% off its all-time, less than 4% off its all-time high on February 19th. Whereas you look at other areas of the market, more cyclical areas of the market, or areas of the market that are tied to things like tariffs more directly, and like transports. You look at the Dow Transportation Average, that is 15% off its all-time high. You look at small cap stocks that are more tied to higher interest rates. We can talk about the Fed too. Small cap stocks are still 14% off their all-time high, which had hit back in November. Remember, that was post-election. That was when we had a lot of optimism. Homebuilders also reflecting the struggling housing market in the U.S. because of high mortgage rates. Homebuilders are still in a bear market. They are off 21% of their all-time high. So there are pockets that are struggling, I think, despite the broad equity market gaining.
Yeah, we've got also a lot of commentary coming through in the latest earnings season. We've got many companies withdrawing guidance, some of them cutting back. And the latest is Walmart falling short of quarterly sales estimates for the coming quarter, and also painting a picture of possibly higher prices where they are looking to pass on cost hike prices. What do you make of this? And what is the appetite for higher costs right now? Are consumers in the right place to absorb them?
I think it's going to be on the harder side because real wages basically have been coming down. Wage growth has been easing. It's not quite like what you had in 2022 when wage growth was running closer to, let's say, 5-6%. Right now, wage growth is running closer to 3%. Right? But what was interesting about Walmart earnings is the fact that we went through a whole month and people are like, wait a minute, we don't see the impact of tariffs anywhere, never mind that the data was from March at the time. And even when we started getting April data, for example, payrolls didn't crash. And that it never should have been the expectation that, the economic data would reflect tariffs immediately. This was never going to be a drop from a cliff. It was always going to be, if anything, more of a slow burn impact from tariffs. But now with Walmart's earnings today, coming back to that, we saw the first sort of clear signal coming from the biggest retailer in America saying we have to probably increase prices because of tariffs.
Yeah, that is definitely going to be felt by many people as they go to Walmart and get their groceries and much more. I've already been hearing about consumer spending patterns, purse strings being tightened and so on. Now, what does this mean for the Fed? Will they be concerned enough to hold back on anything and just sit tight and wait for more data in that sense? Where do they lean towards? Addressing inflationary pressures from possibly tariffs or helping to make policies more accommodative to help the economy?
Normally, you'd think they would act preemptively to, protect the economy, which is probably what they did last year when it looked like the unemployment rate was going up. They stepped in and they did a big cut in September. Now, Powell recently argued that they were probably too late. Essentially, he means, we should have probably cut in July. But because they didn't cut in July of 2024, they had to go big in September. But they did that. Now, I think they missed a trick by not cutting in January and March because inflation had completely normalized. But by the Fed's own admission, they'd said rates are meaningfully restrictive. Now, if inflation's normalized, wage growth is easing, and Powell's own phrasing was that the labor market is not a source of inflationary pressure, there was no need to keep rates meaningfully restrictive. They could have normalized it, maybe brought it down by another 25, 50 basis points across a cut in January and maybe even in March. But now they're stuck waiting for more data, coming back to what you said, Ryan, that the Fed there's a lot of uncertainty around tariffs and also about the employment picture. The Fed has said, there are risks to both sides of the mandate. And Powell noted last week after the Fed meeting that we don't know which one we'll pick. But I think when push comes to shove, they will probably pick the inflation side of their mandate. They'll do first what it takes, tame inflation, as opposed to protecting the labor market. And what does that mean? What does that imply? That means rates are probably going to stay on the higher side for longer.
Talking about the labor market, I'm looking at reports about layoffs in some quarters of the economy. Among them, PwC talking about cutting 1,500 jobs. Also, interestingly, Microsoft laying off about 3% of its workforce. That's about 6,000 people, even though their latest quarterly earnings was pretty decent. What do you make of these moves?
I think we're seeing more of these anecdotes where you see, especially larger companies, but larger companies are the ones that make the news anyway. So especially something like Microsoft. But I think part of the reason, if you look at the tech industry, large tech companies overall, hiring has actually been really weak there, not just recently, over the last 2-3 years, right? And that's probably because they did a lot of hiring back in 2020-21, and there's still, a lot of the workers are probably right now very productive, and they probably hired too many back then. But overall economy, if you look at something like initial claims for unemployment benefits, that will be the first place where we see broad-based layoffs across, almost every sector in the economy, across most states in the country. We're not seeing that now. Initial claims still look pretty benign, which tells you that layoffs are not increasing. Now, that doesn't mean the labor market is really strong, because at the same time, you don't have a lot of hiring, right? So we're in a situation where hiring is not really strong, but net employment growth looks okay because layoffs are low, right? So the question is, is there a shoe going to drop in terms of layoffs picking up later this year? I don't think we know the answer to that yet.
Yeah, some ways to go before confidence is restored. And I think that speaks to the tariff environment, leaving a lot of uncertainty when it comes to planning, budgeting, hiring, and much more. Well, helping us this morning to navigate the markets has been Sonu Varghese. He is the Vice President and Global Macro Strategist for Carson Group. Sonu, thank you for your time as always. Great chatting with you.
Likewise. Thank you, Ryan.
All right, looking forward to having you back on again. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.